Savvy investors not only know how to spot the most profitable chart patterns that launch big price runs, but they're also keenly aware of the psychology behind them. That's helpful in understanding how and why virtually all major stock moves begin after a new chart pattern forms. First, take note that chart patterns, which are also known as bases, typically form after a stock has already seen a nice gain of, say, 30% or more. That gain usually comes as the broader market rallies, helping lift most stocks. But of course, nothing goes straight up forever. The stock will eventually hit resistance and begin to pull back. Stocks can retreat for a variety of reasons. Maybe the broader market rally is running out of steam. Maybe some large investors are selling to lock in their profits. Or maybe a company reported weaker than expected quarterly earnings. Whatever the reason, a temporary pullback is not unusual by any means. It's like when you're climbing a mountain. You have to take a breather every now and then before you start on that next leg up. Stocks form bases for the exact same reason, to take a rest as they get ready to continue their climb. Now, keep in mind that as the stock is making this initial climb, some investors will buy late, just before the rally ends and the stock retreats. These folks will soon find themselves sitting on a big loss as the stock continues to slide. At some point, large investors stop selling and start buying. That stops the bleeding and helps form the bottom of the new chart pattern. If fund managers and other large investors see good things ahead for the company, they'll continue to pick up shares. That institutional buying pushes the stock higher, building that right side of the base. Now, remember those people who bought too late and took a big loss as the stock hit resistance and retreated? Well, many of them have given up on making a profit. They just want to cut their losses or break even. So as the stock continues to climb up the right side of the pattern and gets closer to the price they paid for the stock, these late investors begin to sell and are happy to recoup most of their losses. But if the big mutual fund managers like the prospects of the company and its stock, they'll be more than happy to buy whatever shares these late investors are selling. And because of that, the share price will continue to rise. And then we come to a testing ground. The stock will close in on that former level of resistance that it has not yet been able to surpass. It could be the area on the left side of the base, or it could be at the top of what we call a handle, which is a mild pullback in the right side of the base. Either way, the point is that the stock now has to prove its strength. Punching above that prior area of resistance in heavy volume would show large investors are enthusiastic about the stock. But if the stock bumps its head against the ceiling and falls back down, that would show hesitation and a lack of conviction among big money managers. That's why we use prior resistance levels to identify buy points, the price at which it is optimal to start buying shares. If you stay patient and wait until the stock punches through that former ceiling in heavy volume, you're putting the odds of success in your favor. Now, new investors often ask why you can't buy at the bottom of the base at a lower price so you can make more money. While that's true, only hindsight is 20/20. Trying to get in too early can be just as painful as buying too late. That's why you want to wait for the stock to complete the pattern and clear that ideal buy point. That'll significantly reduce your risk and still leave plenty of upside potential. Remember, chart patterns don't mark the end of the run. They mark the beginning of a new and profitable climb.